December 2003, one of Europe's largest food companies suddenly collapsed. Not because of falling sales, not because of competition, but because $14 billion simply did not exist. For decades, Parmalat had been one of the most trusted food brands in Europe. Its milk, yogurt, and dairy products were sold in supermarkets across the world. Families bought its products every day without thinking twice. Investors believed it was one of the safest companies in the European market, but behind the clean image of a successful dairy empire, there was a financial illusion so massive that it would later be called Europe's Enron. At the center of the story was a quiet Italian businessman named Calisto Tanzi. Tanzi was born in 1938 in Parma, Italy, a region famous for its food culture and dairy farms. In 1961, at just 22 years old, he took over his father's small milk processing business. At the time, it was a modest local operation supplying pasteurized milk to nearby towns. But Tanzi had bigger ambitions. He believed the future of dairy was industrial-scale production. Instead of small local dairies delivering fresh milk daily, he invested in modern technology that allowed milk to last longer. Parmalat became one of the first Italian companies to widely use UHT processing, a method that allows milk to remain fresh for months without refrigeration. This innovation allowed Parmalat to expand rapidly. Throughout the 1970s and 1980s, the company grew beyond Parma and across Italy. Then it expanded internationally, entering markets in Europe, Latin America, North America, and Asia. By the 1990s, Parmalat had transformed into a global food conglomerate operating in more than 30 countries and employing tens of thousands of people. Its annual revenue climbed into the billions. Banks eagerly lent money to the company, and investors saw it as one of Italy's greatest corporate success stories. Tanzi himself became a respected figure in Italian business. His wealth grew into the hundreds of millions, and Parmalat even sponsored the famous Parma Football Club, turning it into a major European team. But behind the impressive growth, a dangerous financial problem was quietly building. Parmalat's expansion had been fueled by enormous borrowing. The company kept acquiring new businesses, entering new markets, and spending aggressively. Debt levels began rising faster than profits. At first, this wasn't unusual. Many large corporations rely on borrowing to grow, but Parmalat's debt was becoming dangerously large. Instead of slowing down or admitting financial pressure, the company began doing something far more risky. It started hiding the debt. Through the 1990s, Parmalat created a complicated network of offshore subsidiaries in places like the Cayman Islands. These companies were used to move money around the corporate structure and conceal liabilities. Instead of reporting billions of dollars in debt on its main balance sheet, the company shifted those obligations into offshore entities. At the same time, Parmalat's financial reports claimed that the company held enormous cash reserves. This raised an obvious question. If Parmalat really had billions in cash, why was it still borrowing so heavily? The company's explanation was simple. The cash was held by international subsidiaries and reserved for future investments. Most investors accepted this explanation without questioning it. But one particular claim stood out. Parmalat stated that one of its Cayman Islands subsidiaries called Parmalat Financing Corporation held nearly $5 billion in a Bank of America account. This supposedly proved the company had massive financial strength. In reality, the account did not exist. For years, this fake asset helped maintain the illusion that Parmalat was financially healthy. Then in late 2003, the illusion began to break. Parmalat suddenly struggled to repay a relatively small €150 million bond payment. Financial analysts were stunned. A company claiming billions in liquidity should never have trouble covering such a payment. Questions began spreading through financial markets. Auditors demanded proof of the mysterious bank account tied to the Parmalat subsidiary. Parmalat provided a document that appeared to confirm the existence of the funds. It looked like an official confirmation from Bank of America, but when investigators contacted the bank directly, the truth emerged. The document was a forgery. The account holding $5 billion simply did not exist. This discovery triggered a massive investigation. As authorities dug deeper into Parmalat's finances, the situation became even more shocking. Investigators discovered that the company had spent years manipulating financial statements to hide enormous losses. Debt had been shifted through dozens of offshore entities. Fake transactions were created to make the company appear profitable. Assets were invented and liabilities were concealed. The deeper investigators looked, the worse the numbers became. Eventually, the scale of the fraud was revealed. Parmalat's accounts contained a $14 billion hole. At the time, it was one of the largest corporate frauds ever uncovered in Europe. Thousands of investors had bought Parmalat bonds believing the company was financially stable. Banks had extended massive credit lines based on falsified financial statements. Many ordinary families had invested their life savings into what they believed was a safe Italian company. In December 2003, Parmalat officially collapsed and filed for bankruptcy protection. It became the largest corporate bankruptcy in European history at the time. The scandal triggered investigations across multiple countries. Prosecutors, regulators, and financial investigators began examining the company's leadership. Soon the focus turned to Calisto Tanzi. The once celebrated founder and billionaire entrepreneur was arrested and charged with fraud, false accounting, and market manipulation. Court proceedings revealed that the financial manipulation had been happening for years. The fake accounts, offshore structures, and forged documents were part of a desperate effort to keep the company alive while hiding its growing debts. In 2008, an Italian court sentenced Tanzi to prison for financial fraud. Several other executives were also convicted for their roles in the scandal. Despite the enormous collapse, Parmalat itself did not disappear completely. After years of restructuring under government supervision, the company stabilized and continued operating. In 2011, it was eventually acquired by the French dairy giant Lactalis. But the scandal left a lasting mark on Europe's financial system. It exposed serious weaknesses in corporate oversight, auditing practices, and financial transparency. Parmalat had once been a symbol of Italian business success. In the end, it became a symbol of how easily trust in financial markets can be manipulated when numbers on paper are treated as truth without question.